3, 2, 1.
All right. Here we are at the end of a quite challenging week for the market, I would say. Yeah.
Crickets.
Dude, so much going on. So the Fed paused this week. We were in here on Wednesday listening to the comments and the Q&A.
Yeah.
And I thought the one thing that stuck out to me on that Q&A was somebody asked about going back to the zero bound, which basically means does the Fed drop rates back to zero? Mm. And there's it's one of the big questions that economists have, whether or not if the next big problem in the market, when it happens, is the Fed going to drop rates back down like close to zero? And that's been the history, right? 2008, COVID, like they come in and they rescue the market. And then it just kicks the can of an eventual monstrous meltdown. It just keeps kicking it down the road. And so somebody asked him about the zero bound, and he was like, oh, yeah, if we get something like 2008 or COVID, yeah, we're going to have to lower rates back, and they kept on moving.
Yeah.
And I was like, that is answering a giant question because, they're on this higher for longer kick, which is, if you listen to the Bloomberg guys, supposedly the reason the market tanked on that Fed announcement was because they have a thing called the dot plot, and all the Fed governors get together with the chairman, and they have this meeting. It's like every other month basically. It's the FOMC meetings, and they decide what they're going to do with interest rates, and they each have a vote, and so their votes are public, and like they're not anonymous, right? They all have a vote. And part of what they do is they anticipate for the next 12 to 18 months what they expect to do with rates. And going into this Fed meeting, there was a lot of expectation that they were going to cut rates like 4 times next year. There's a lot of expectation that they're going to smooth out this soft landing kind of thing. They were back and forth about whether or not to do one more rate hike this year, but there were 4 cuts for next year going into this. Then this meeting, they come out and they say they're only expecting 2 cuts next year. So supposedly that is what threw the market in a tailspin.
Yeah.
I thought there was much more positive
I know.
than there was negative.
I know. I even made mention to you. We watched the guy afterwards. One of the pundits was
Bill Dudley. He was a former
New York Fed.
New York Fed president. Yeah, he said the same thing. Like he thought the market would have responded really favorably to those remarks.
And they heard different things than what we heard.
Yeah, I mean that's obviously the market tanked, and I don't know. Is it because they changed the dot plot to 2 cuts instead of 4 for next year? I mean, who knows? But there was that. There's also apparently an impending government shutdown.
Apparently.
I mean, especially after, I guess, what day? So it's Friday morning. So last night, or yesterday, the House couldn't get their stuff together, and they couldn't even they were trying to do a procedural vote.
Yeah.
And it failed.
It's just such a hot mess right now.
Oh, yeah.
Don't even want to get into the politics.
No, it's pointless. But the point is, if we get a government shutdown, it'll certainly have an effect on the market.
Absolutely. Yeah. I mean, we were there for at least two of those.
Yeah.
And it was a mess. I mean, I don't even want to go back to thinking. I mean, thankfully we're out of that now. We're retired, but we've got so many friends that are still there, and it's all just kind of like, because depending on what you do in the government, like we were in, law enforcement, military, like those kind of things, you just keep doing your job whether you're getting paid or not, right? You just because the bad stuff doesn't stop happening,
right.
And so
you're an essential employee.
Yeah, you just keep working, and you're like, well, they'll figure my paycheck out or they won't, And it was such a weird time that one that went on for a while,
like 2 paydays.
Yeah, there were people on vacation, that had taken leave and were told, like, if you come home right now, you won't be furloughed or something. I don't know
there was all kinds of goofiness about all that.
My goodness, it was crazy. All right, let's get on to better topics. So you got something like bright and shiny,
Bright and
happy
shiny?
for us?
Honestly, I'm not sure. Honestly, as we go through this, you might have to talk me off a couple of ledges, but I'm gonna wait until later in the show for all that. So I'm gonna do this this email from JC Peretz. We talk about him all the time. It's allstarcharts.com is his site. He's a really good technical analyst. But I also got an email from him this morning, and I want to kind of do that at the end. But we're going to talk about the tech, industrials, home builders, and semiconductors are 4 sectors that are really important if this rally is going to continue, and we'll take a look at the charts of that. Bonus chart is credit spreads. If you ever hear this idea that people get really worried that the market's going to tank if they say credit spreads blow out, okay? And we'll just take a look at what those charts look like, and then the weekly TSP fund charts. But before all that, we got this question that I thought we would just kind of kick around because there's no straight up answer for it. So I understand the typical purchase of each TSP stock fund to be spread out across each fund. So what they're saying there is what we generally do is not always, but generally will allocate if the market's going up, we'll allocate across all 3 stock funds. And if it's going down, sometimes we'll be in the F fund, but generally if the market's going down, we'll be in the G fund. And so he's saying, let's say if you invested equally in each stock fund and the S fund's technical analysis indicates it's time to sell, right? With the implication meaning the I and C are still moving higher, but the S fund is time to sell. So do you ever move back to the C fund from one fund? The S fund in this example. Appreciate you guys, thanks.
Or the G fund. You said C fund, but you meant G fund.
Yeah, do you ever move back to the G fund?
G, yeah.
So of course you can, right? You have two free moves a month, and this is what it comes back to, right? You have 2 moves a month. It doesn't matter how you reallocate. It doesn't matter if you go into the G, out of the G, what percentage you move your money around. If you have 2 moves, and the L funds are included in there. Any 2 moves that you do, you can do anything you want, any reallocation you want. Every move after that in a month, you can only increase your exposure to the G fund.
G, yeah.
Right? So let's say it's the 20th of the month. You got, 5-6 trading days left in the month. And you've already used your 2 moves. And you have some amount in the S fund. Okay? At that point, you can move all of your S fund money to the G fund, let's say, because he's saying the S in this example. All of your money from the S to the G, or a little bit every day from your S into the G until the end of the month. Because if you've already used your 2 moves, then there's no effect. There's no negative effect of you moving from the S to the G. If it's the beginning of the month, or if you haven't used your 2 moves yet, if you use one of those moves to go from S to G and you leave C and I alone, that's one move. If your second move, let's say, you want to move some of the I to the G. Now you've used your 2 moves. So now you have whatever you have in the C, let's say, but you can't, if the market turns back up, either the I or the S or, the C, you can't move back into the stock funds, right, to any of the stock funds until the next month.
Yeah.
So you really have to think through. I mean, yeah, you can see that the technicals on one fund are deteriorating and you want to move out of that fund. It's just, you have to think through the tactics of where you are in the month and how many moves you've used.
Right. We always say it's chess, not checkers, right? So you always got to think really 2 moves away, or 2 or 3 moves like you do in chess. You're like, okay, just because I move this piece, and I move from one fund to the other, what does that leave? Where am I at in the month? How long do I have to, hold that position because I got to wait for the next month to come and get my 2 moves? We've also talked about how, if moving to G wouldn't count against you at all, that would allow you to do what he's kind of describing, which would be wonderful because that would give you the safety, because that would solve the problem of what they're trying to do, which is always allow you to get to safety, safety being G. And so if a move to G, if you were spread across C and S, and we've talked about it, sometimes, you don't know until the trend is confirmed that the S is going to outperform the C, And so you say to yourself, okay, I want to go C to S. Well, that should count as a move. But what if you went C to G, right? And you took that off the table and just stayed what you had in S. That shouldn't count against you, right? Because you're just moving to safety. Yep. They're not going to make that rule happen, so it doesn't matter. But that would be a more practical version of it, right? This whole idea of you get two moves and then after that, as Jerry and I have been working with people with 401ks and actually building our own 401k for our company and all this stuff, you start to realize how good the TSP is.
Yeah. Right.
And I almost hate saying that because we do tend to take a negative stance on some of these rules, but there are way worse versions.
Oh yeah. Way worse
versions. Some 401ks you can make one move every 90 days. Another one is it's only on the pay period, which what the heck does that have to do with anything? Yeah. It's amazing what rules they come up with in 401ks to make these same moves. All things considered, get rid of the noon rule and I'd be happy with the rest.
The noon rule is without a doubt the worst.
The dumbest. Because you saw it happen. If you see something happen this morning and it's happening, it should take effect when I make the move. I should get that price.
You get that in the mutual fund window.
I know. Why can't I get that price and why I got to wait till the closing?
Right. I mean, a great example is this week, right?
And if I miss the noon, then I got to get the next day's closing. That's just crazy.
If this week, Tuesday, the market had been struggling at that 20-day moving average line for the last week or so, but it hadn't broken down. On Tuesday, at some point during the day, it was above that 20-day moving average line. And on Wednesday, the market opened higher before the Fed's comments. So we were good until noon on Wednesday, right? By the close on Wednesday, not even by the close, by easily 2:30 on Wednesday, it was pretty clear that the market was tanking. So if you could have gotten out at 2:00 on Wednesday, well, if you did a reallocation at 2:00 on Wednesday, you got Thursday's closing price because you had to have it in before noon. And of course, at noon, everything looked great. So the noon rule is the worst. But the rules are what they are. And you can't.
I know.
What would you have done on Tuesday? You're going to look at the market and go, okay, I'm going to get out because I'm going to guess that the Fed's going to say what it says, and the market is going to tank, and therefore I'm going to get out. Like, you can do that, and you might be right. Sometimes you'll be wrong. I mean, you have to. You don't have to do anything, but the only way that you can do a repeatable process is to respond to what the market does and not try to anticipate it. You try to anticipate it, but if you make decisions based on what you think is going to happen,
you're in trouble. Yeah. Particularly when you're just in trouble in managing it in the rule sets that we have. So you have to let it confirm. You have to, and if you don't, then you're just gambling. Put it all on red and let's go.
You basically have three ways to manage your TSP. You can either have a methodology to use it. It doesn't have to be ours. Right. But have a methodology.
You mean like an active methodology where you're actively engaged?
Well, yeah, it can be seasonal strategies. Sure. There's plenty of them out there, right?
But you're actively managing it somehow.
Right. But you're actively managing it. Or you can be buy and hold.
Yeah.
And just then I don't know why you'd be listening to any of this stuff because you're buy and hold and you do it, right? And now you're going to take the ups and the downs. You can be really excited that you're up. If you were in the C fund this year, forget about the last couple of days, but if you were in the C fund this year, you're up like 17%. S and I are not even close, and S hasn't recovered. We're going to look at that on the weekly chart. But if you were 100% C fund and you were buy and hold, prior to this week's sell-off, you were up like 17%. Now, to get that 17%, you had to be in last year, right? And you would have taken a 20% decline last year,
right?
And then from a 20% deficit, right, you're adding 17%. So what does that mean? If I didn't work this out for the numbers, but if you lose 20%, we can do it real quick. So if you have 100,000, you lose 20%, you're at 80,000. You add 17% of 80,000, that's where you are. You're not back to zero.
Right. This is the part that so many people just want to forget
Yep.
or don't even understand, take time to understand. And that is, this is one of the key pieces to our methodology is we don't want to take that 20% loss.
Right.
It's not that we won't take any of it. We're going to have to because we got to wait for the trend to change.
No, in 2022, we took 0.7%
right.
of the loss. Of that 20% down,
Right.
ours was 0.7%.
Yeah, I know. And then, you know, why can't we get to 17%, right? Well, you could if you just wanted to just be in there, right? But you had to take and you can't do both. That's the problem. And then everybody wants to do both, right? So they want to be buy and hold when it works, and then they want to actively manage when it works. And that's not how it works, because you can pontificate all day long of, well, I would have been out. Well, no, you wouldn't have, because if you're true buy and hold, you'd have been golfing or whatever, fishing or whatever you're doing. You wouldn't have been thinking about this. And I have respect for the people that know themselves well enough to know they don't want to do this. And they're like, I'm going to put it in CNS and go away for 30 years.
Sure, absolutely.
And I hope the timeline works, that you get out when it's on an uptrend, and I hope it all works out, because it probably will.
Yeah, good.
Considering 30 years of the market, right? But if it doesn't, and it's 2008 or, you know, whatever, like, then no.
Yeah.
But you can't haggle over, you know, well, you know, I'm only up 7 or 10%. Man, go. I hate going down this road, but like, go find a financial advisor that will, you know, tell you that's a bad thing. They'll be like, hey, I'd be happy. Like, nobody's beating the market right now.
No,
because it's so hard. Even if you don't have the rules we have, you still have what is basically sideways. Yep. If you zoom out when we go back and look at this time frame of the market, it's generally sideways enough, meaning that there's not these big swings for a long term, downswing for a long term.
We'll see it on the weekly chart of the S fund.
Let's move forward, because we're people are used to hearing us say this stuff, and I think they either get it or they don't. But if you don't understand that you couldn't have gotten the 17% without taking the 20% loss, we don't know how to help you, because that's the key takeaway. And that's actually what, you know, Jerry's over these years have built basically a fundamental rule, right? We used to say this all the time. Rule number 1, don't lose money. That doesn't mean you're going to lose any money. Right. It just means, like, I don't want to take that 20% loss. I would rather be out of the game and wait for the trend to come back up, and then I'm like, okay, I'll take what I can get, you know. But it's better to get a little bit and lose a little bit than to lose a bunch and hope you get it back. Because those people that were in when they lost 20% and now it's up 17%, you're not back to zero. You're not back to where you were.
And that's if you were in the C fund. And when we get to
it gets even more complicated after that.
It gets much worse if you were in the S, particularly the S fund, or the F fund. God forbid you're in the F fund in the last 2 years, because you're down, historically down in 2022, and then you're down further in 2023.
We're not even past the first slide.
I know. All right, so JC Peretz, allstarcharts.com. Like I was saying earlier, like, it almost feels like there's so much happened this week that this is like a kind of mood at this point, but it's really not. So this is kind of a chunk of his newsletter. All of these groups of stocks are stuck below their late 2021 highs. Tech, industrials, home builders, and semiconductors stopped going up at the exact same levels where they stopped going up the last time they were up here. The new 52-week high list peaked over 2 months ago. Okay, so that's the whole list of all, like, the 5,000 stocks. He has a list of the companies making new 52-week highs. That list peaked 2 months ago, back in July. Until these groups of stocks are able to break above those former highs, the S&P 500 is going to continue to have a hard time making any progress. Seasonally, stocks should rip higher into the end of the year, starting in October or maybe early November. But without breakouts in these charts, I'm not sure it will be that simple. So here are the charts. Tech sector, okay. Here's 2022, the top in the tech sector. Came down, came back up, did a little poke above that line, came down, retested it, failed, came down, and now we're down here after this week, right? I don't know how far down, but it's come down further. So what he's saying is tech is the big driver, right? if tech can't get back above these highs, if this doesn't happen, it's going to be very, very hard for the S&P to continue rallying. Okay, so while seasonally we're looking for a rally in the fourth quarter, if tech isn't leading it, it's going to be very, very tough to happen. Industrials, same thing, right? Industrials had a nice double top up here going into 22, got above it pretty well, but now came back down, tested it, failed because we didn't get new highs, and now industrials is below the line again after this week. So until we can get above the previous high, it's going to be very tough it's impossible, obviously, for the market to keep going higher. Home builders, right? Really good double top. And as we know, as interest rates continue to go higher, which they absolutely spiked this week, home builders are under pressure because it's a very interest rate sensitive industry, right? If people can't buy houses because the cost to borrow keeps going up, then home builders stop building homes and home builder index goes down. So again, seasonally, you would expect in the fourth quarter in general and in the third year of the presidential election cycle, huge tailwinds for prices to move higher. But until we get above these prior highs, it's going to be very tough for the S&P to do it. And then semiconductors. I mean, the semiconductor index, it's huge. It's NVIDIA, even including NVIDIA and all the rest of them. I mean, had a really tanked big time, like the rest of the market, but on a percentage basis, it was much bigger. So we're up here at say 160. So 80 is a 50% loss, and we got down to basically 80. So the semiconductor index lost 50% of its value from the top in January 22. And this is actually a good example. So if we're up here at 160 and we get down to 80, that's a 50% loss. This is a 100% move. From 80 to 160 is a 100% move. So you need to make 100% on your money to get back to where you were at the prior high if you have a 50% loss. And that happened in the semiconductor space since the bottom in October last year. But now it's hitting the prior high and it's hitting resistance there. And it's rolling over. So unless semiconductors can do a U-turn and get back up here, the S&P is not able to get above the prior highs. Okay. So put that chart on pause for a second because I wanted to read this. So I got this email from JC this morning. The stock market is messy, not trending higher, and frustrating many investors who haven't studied their market history. This type of market environment this time of year is exactly what we should expect as investors. If the market was not acting this way, then that would be weird. Sometimes the market ignores seasonal trends, and that tends to be an important signal. But to be clear, this is definitely not one of those times. The market is doing exactly what it should be doing. So what does he mean by that? This chart is in blue, is going back to 1950. So it's the average year for a pre-election cycle year, right? So the year before an election, every time that happens, going back to 1950. Okay, so that's what that blue line is. That's what the average price movement is in that year. So what that means is the first half of that year tends to be very positive. And the red is what's actually happening now through the 18th, I think, or through the 15th of September. So the red is what's actually happening, and the blue is what we'd expect to happen based on history. And it's following relatively well, right? And this is the challenging time of the year, but then we tend to get a bottom in October, November, and then have a really strong fourth quarter. So that's what they're talking about when they say seasonally, that's what we expect. And that's what he means when he says right now, the market's doing exactly what it should be doing. It's messy and sideways and all that, okay? So if this was the only thing you were looking at, you would say, okay, I'm just going to either go into the G fund until we get some kind of breakout here, And you could say, I'm going to go in the G fund until November 1st because the seasonal chart looks like on November 1st it's going to break out. That's a plan. And that could be what happens. But at the same time, come November 1st, if the sectors that should be leading have still not gotten above this resistance level, then this is not going to happen. Okay? So there's no crystal ball. You can guess or you can respond. Those are your options. Or you can just buy and hold and hope for the best. Okay. Credit spreads. So there's an idea out there that a lot you may have heard it in financial media about credit spreads. It's very complicated and it's not worth really going into the details of it. But when high yield, if you buy credit in companies that are risky, they have to pay you a high interest rate to buy that credit or debt from them. And so the difference between what it costs to buy risky credit versus what it costs to buy cash is the ratio of this high yield spread. And this particular one is option adjusted, which makes it more complicated. But the bottom line is this. When you hear people say, I want to see credit spreads blow out before I'm really worried about what happens in the market, this is a blowout in credit spreads. Okay? When credit spreads are declining, the stock market is going up. When credit spreads blow out, well, this was COVID, the stock market crashes. Okay? So after COVID, we had a peak in credit spreads. Credit spreads comes back down. Stock market's going up. Now here, credit spreads start to flatten out, right? That's telling people that the fear is increasing in the market. And then credit spreads blow out. 2022, the market crashes, okay? So where are we right now? Credit spreads are declining. And a lot of people are like, how can credit spreads be declining when all these macro factors are in place? Like because high yield debt is risky companies that are issuing debt and people are buying it. So if all these macro indicators are in place, why are you going to buy risky debt when you could get 5% in a treasury bond? So it doesn't make sense, but as long as credit spreads continue lower, the stock market continues higher, right? So if you drill into it a little bit closer, I mean, do a measured move, we've talked about this quite a bit, but each one of these blue lines is the same length. So when we had a peak here in July last year, a peak in credit spreads, then we had a decline, right? This was the length of that decline. We had a rally, then we had another decline in credit spreads, the same distance. Then we had a rally, another decline in credit spreads that puts us to where we basically are right now. And so what happens when credit spreads goes up? The stock market goes down, right? So if you're doing an analysis of credit spreads, which obviously I did this week, this one tool was telling us to be on the lookout for credit spreads to start moving higher because we have the same measured moves to the downside, and every time we got to the bottom of it, credit spreads went higher, right? So we got to the bottom of it here, credit spreads should be going higher. And I don't have the updated chart for as of the last 2 days, but I'm going to guess if I went back and looked at it, credit spreads blew out over the last 2 days. So it's just one tool. Credit spreads is a good one. It's something to look at. Okay, TSP fund charts. So here's a weekly chart of the C fund, okay? The blue line's 20-week moving average line. You get RSI and MACD down here. So a couple things. Nobody has a crystal ball, right? COVID was a huge decline. 2022 was a huge decline. Usually when you have big declines, and you put in a significant bottom, you're going to get a rally for a decent amount of time, right? You're going to have pullbacks in that rally. So here was the first significant pullback in the rally from the COVID bottom, okay? Here's the first significant pullback in the rally that we had since the October bottom. Now you can argue that this is a pullback, but we didn't have a V bottom here like we did back here, so it looks a little bit different. But we had an extended rally here, and now we're in this consolidation period. Okay, these look pretty similar, right? You got RSI back here, and it happened to be the same time. It was September of 2020 where this was happening, but it looks very similar, right? RSI here and RSI here looks very similar. Okay, as long as RSI is above that 50 level, price is going up, right? When RSI is below the 50 level, price is going down. It gets back up above the 50 level, price is going up. So RSI is a pretty key indicator. The problem is you have to wait until it gets below the 50 line, because you get, like here, it get down right to it. You got support at that 50 line, support at the 20-week moving average line, and price kept going higher. Okay? So you have to let it confirm. Okay. The red line, the market's coming up in 21, tops out here in 22. One of the last pullbacks, again, back to that 20-week moving average line. We get a peak, market comes down, gets support at that line. Comes down here, gets support. Comes up, comes down, breaks through that support, comes down, back up, it's resistance there. Okay? So we got, this line becomes pretty significant. We get a breakout above that line, which is now good. So now this line should act as support. Market rolls over, tests that support, and it works, right? It holds. Now, we didn't go up to new highs yet, but we got support there and it held. And then this week, the market rolls over, right? We're now on a weekly basis, we're below, just a little bit, but below that 20-week moving average line. And again, this is through the close on Thursday, so I'm not sure what's going to happen today on Friday. But as of right now, we are right on that support level. And we're right at 50 on RSI, right? 50.12. So the question is, are we here, right? And the market rallies and keeps going like it did in 2020? Or, are we like here and the market's getting ready to move to the downside and we have a big decline? If you're looking at it on a weekly basis like this, you have one of two options basically. You can buy it here with the expectation that it's going to move higher. And then if it closes, down here somewhere, you get out. You take that little bit of loss to risk the upside potential gain is that the market keeps moving higher like it did here. Right? So that's if you were being aggressive, you would actually buy it here. If you were being conservative and you're like comparing, if you're saying, all right, well, I had $1 million in TSP here, and I've already lost X percent, I'm not willing to take that extra risk, then you would sell it. It comes down to your personal circumstances and risk tolerance, and you're looking at the market, and you have to decide.
But I wouldn't even say that's conservative. I would say that's, again, it goes back to our methodology is I'd rather not lose the money, right?
Sure.
Or I'd rather not lose a lot of money.
Yeah.
And so I don't know if that's necessarily, I say that and it sounds conservative, but to me it's just more practical, right? And so riskier is not necessarily, a good thing, right?
Right.
And so aggressive, all this terminology is just kind of whatever it is, right? But at the end of the day, like it wouldn't be practical to risk that if you had a lot of money on the table, right?
Right.
Yeah. Like if this is like your retirement account,
Right.
right?
So, and why wouldn't it be? Because the first four charts that we showed are telling you that until those sectors can get above the previous highs,
Yeah.
the market isn't going higher, right?
Right.
So the risk right now is to the downside.
Yeah.
It's until we get above those prior highs. Once we do, then
it's off to the races.
It's off to the races, right?
Yeah. But if this was $5,000 in my brokerage account or something like that, and I was playing this same scenario, okay, well, there's not a lot on the table, and I'm willing to risk that.
Sure.
If this is my retirement, this is what I'm going to live off of. I'm just trying to put that in context, because whenever we say like conservative versus aggressive or whatever, sometimes people are like, "Oh, you guys are too conservative." I would argue that we're not. Like we're pretty aggressive when it comes to the fact that we're in our retirement account doing this. So that context is important, right? This wouldn't be aggressive if I was in a brokerage account playing with money I don't need, and that's what it should be if you're playing with it. It should be money you don't need. If you're playing with 20 grand in your brokerage account, you shouldn't need that. If you are
to live on,
you need to stop.
Yeah.
Right. That's a whole nother topic. But we're talking about our retirement account, I do need this, right? And so that's not necessarily conservative. It's just practical. It's prudent, right? It's risk averse, which is what you should be.
Yeah.
It's risking large downside.
Right. And to be honest, it certainly matters more if you're close to or in retirement. But if you're 25 and you're
matters just as much,
right?
Because you need that snowball,
right?
You need that big thing to keep growing, and you can't ever get there if you keep taking these losses,
right?
Yeah.
And people argue, well, you guys are taking little losses along the way. Yes, we're definitely taking little losses along the way to be able to be in the right position, not to take big losses, and B, to be in the market when the trend does get confirmed to be moving higher.
Yeah, and if you go back and look at a long-term chart, 10 plus years, if we could pull all this up for 20 plus years, you'd see that we were never in the market. I can say that because, I was following the methodology and look at my quarterly statement, and all those times that we took those big hits, I didn't take those hits because I was in the G fund.
Right.
All right, we're close to the end.
Yeah. So here's the S.
You guys
fund.
are still hanging on.
Here's the S fund, right? Here's the thing I wanted to point out, and it's to your point from before. Here's the August high of last year. This year we got just barely above it. It's basically a double top, and so essentially not a triple top. You connect those lines, and say we connect these lines. We're in this channel, right? We're not making much progress, and that's back in June of last year. So, the C fund looks different because it's the 7 mega cap tech companies that have been driving the C fund higher, right? But even the S&P 500 is 500 companies. The S fund is 4,500 companies. It's much more representative of the broader market, and it's flat. It's flat, and it's not really. What is this? 1, 2, 3, 4, 5, 6 weeks. 1, 2, 3, 4, 5, 6, say 7 weeks. So if the range is 6 weeks up and 6 weeks down, very tough to play in TSP where the rules are 2 moves a month.
Yeah.
Right?
Yeah, that is very difficult. And it'd be difficult for anyone, right? I mean, that's what I was saying earlier, right? That whole sideways moving thing. It's like, and this is on a smaller scale, but you're still, when you zoom out from that, it's going to look pretty similar to that when you're zoomed out, right? It's going to be pretty much sideways. And I don't care what methodology you're following or how you're playing the market. When the market's going sideways, it's very difficult.
Yep.
You really need ups and downs, significant.
Yep.
Not percentage wise, but time wise.
Yeah.
It could just gradually go up. That's fine.
Yep.
That's easier to play than if it's just, that's just, it is what it is.
So here's the top before COVID, right? Obviously a lot of churning at that same level, but eventually the market breaks out to the upside. And that's what we're hoping happens for a fourth quarter. This was in the fourth quarter. This is what we're looking at before in the C fund. And in the fourth quarter, it explodes higher, right? So that's what we're hoping to see, and that's what seasonality would tell us is going to happen. However, this is not looking anything like this, right? This was a really bad week for the S fund. It came down, got support for the last 3-4 weeks at that 20-week moving average line, and this week closed big time below it. RSI below 50, MACD to the downside. A big weekly sell trigger for the S fund. Okay. Head and left shoulder, head, right shoulder. I think I did this on the alert analysis that came out. I did it on IWM, the Russell 2000, not on the S fund, but it's basically the same thing. You connect this neckline, and we get a big decline through it. So what does that mean? The minimum downside you would expect on a head and shoulders pattern is the distance between the head and the neckline to the downside. So this is the essentially the projected downside, which takes us right back to the bottom of the channel, right? Nothing really is changing. If we get down here below outside this channel, now we're in trouble, because now we got a 1, a consolidation for 2, and a 3, and S fund goes much lower. All right. And the last thing I want to say about the S fund is this. 2,400 at the peak. 1,500 at the low in October. So I don't know what the percentage is, but it's a lot. 50% would be 1,200. So it's not 50%. It's 40% downside. S fund has only recovered maybe 30% of this loss at its peak, right? I mean, the S fund has not recovered very much, and it's the majority of, it's 4,500 of the 5,000 stocks traded in the U.S. So the market is not doing well, and now it looks like it's going to start doing worse. But the broad market is not doing well. If you were 100% C fund and you got your 17%, that's great. If you were 50C, 50S in 2023, you're nowhere near 17% because the S fund hasn't recovered that much. If you were in the I fund, you did really well. The last half of the last quarter of last year got you to here, right? You're negative on the I fund at this point for 2023. So if I get frustrated. I mean, we get hate mail every day and comments on Facebook and all the rest of it, but I don't know how to make people understand to look at actually apples and apples. It's very frustrating. But
that's what people, we have a tendency to do, all of us, right?
Yep.
We kind of pick and choose the data that we want to conform to what how we want to explain why it happened, or why someone else is wrong and I'm right,
Yep.
or whatever. When it's like, we work really hard on trying to compare things that should be compared, right?
Yep.
Apples to apples. And or just conveniently leaving out part of the information, right, which we see a lot lately when and people are frustrated. And I get it.
So am I.
We're all frustrated
sure.
with the market. When I watched the Fed announcement, and I don't normally watch them all because I hate listening to the gobbledygook.
Yep.
Meaning, what I mean by that is, I used to work when I was in the government. I had to take my turn through public affairs, right? And I did not enjoy it. And one of the unfortunate things that I learned was that is the job of the person speaking, is to not really give an answer, right? And so they're masters at it, and they do give you a little bit, but not everything. And so anyway, but you watch it and you pull out the data points, the things that he actually said, and you say to yourself, oh, well, this isn't a really bad, this is kind of a good thing. Yeah. I think we're heading in the right direction. And then the market turns the way it did, and he goes, were you watching something different than I was watching? And it wasn't that they were watching something different, is that they heard other points that mattered more to them, right? And so that makes sense, right? They responded to things that maybe I looked at, that were like, it's not as big a deal. Yeah. That's kind of how it works, right? And the whole market is just people. Yeah, making decisions based on their emotions. We'd like to think that we're not, but a lot of it is that way. And so the more that you can take your emotion out of it, the better. Yep. And that's usually the biggest takeaway for that we try to teach people, like, because this whole thing is an educational thing.
Yep.
We're not trying to tell you what to do with your money. I know half the time, people want to say that.
People
but
want that.
We're really not. What we're really
No.
trying to do is get you educated enough for you to do this for yourself.
Yep.
And it's not that difficult. It takes some practice and some work. But as you do that, you gotta do a couple things. You gotta take emotion out of it and just make decisions based off the information, and not hope and not wish, but just execute when the thing happens, when your plan changes.
Yeah.
Or when the thing changes, you always got a plan A, plan B. What's my next move? If this is the end point, you better have an out point.
Yep.
If you got an out point, you better have an end point. And if that happens, execute it. Play your methodology, your game. And then see how it works and go back and do some lessons learned. Like that's how you progress in all of this.
Yep.
And that's what we're trying to get people to do and understand.
A lot of people do.
There are a lot. There are a lot. And we actually just said this right before we came on the podcast. We have the unfortunate position that we generally don't hear from a lot of the people that are getting it.
Yep.
We hear from the tiny people, portion of people that are not, they're not tiny people. I didn't mean that. The tiny portion of people that aren't getting it, and so we hear that feedback and we're like, oh, come on, man.
Yeah.
We're trying here. We're trying to get the knowledge out. And that's not a like a request for pats on the back.
No. I mean, I don't need,
Yeah, we're not going to change. It's nice. It is nice when people say nice things, but we're not looking for that. Really, what we're looking for is what we didn't have when we were in the government.
Yep.
When I was 30 years old, if somebody was telling me how to manage my TSP, I would have had a significantly different, outcome after 30 years in the government. And more importantly, I feel like, our service members are they're so far behind the power curve when it comes to understanding how big a deal the TSP is for them now.
Yep.
It wasn't a big deal for me in the Army. I never had to deal with a blended retirement system. And they don't have a choice now. They are like we were as civilian, federal civilians.
Yep.
And it's
a huge opportunity.
It's a huge opportunity if you are educated.
Yes. And
if there are probably, I'm sure that the commission officers are just as kind of uneducated in this as many, but our junior enlisted are the ones that, for 10 years that it takes to get to, whichever branch. I'm going to talk about Army timelines. 10 years later, you're probably in E6. If you're a super high speed soldier at E7, maybe or something. But like, there's a long time in there. And then that next 10 years, like you have to have at least incrementally learned how to manage that retirement account, at least a little bit, so that when you get to that point, you're like, okay, I got a nice chunk in my retirement account. But I'm not going to stay in the military. I'm going to go over here and get back in the private sector or go to the federal government, whatever it is. You can take that with you now. That's a great opportunity, but not if you weren't doing anything with it. Right. And I don't know. I worry for our junior enlisted and our junior officers. I mean, even our senior officers. We talk to them now, because they're our peers. They're the old guys and gals, and they hate this blended retirement system.
They don't like it
because they don't want to have to deal with that. I'd rather have a fat annuity too.
Yeah. All right. So, last thing on the iFund. Yes, if you were fortunate enough to catch this move, if we had the relative strength charts up of the iFund versus the C fund, because everybody downplays the iFund as never being any good. The C fund always outperforms the iFund. The iFund hugely outperformed the C fund in last quarter of 2022. But since then, this is the beginning of 23, it's negative. So if you're in the iFund in 23, you're negative for the year. And it's not looking like it's going to get any better. You got this rolling, JC calls it a frowny face. You get RSI cannot get above 50, and MACD is well negative. So the iFund is not looking good. It's been trying for several weeks to get back above that 20-week moving average line, and it's not happening. And the reason is because the dollar keeps moving higher. F fund is a complete disaster. You can't possibly get the the historical decline from here to here. There hasn't been this big of a loss in the bond market since like 1750. It's just mind-boggling. And you would think that after such a historical decline over the course of more than a year, this was June of 2020, and it bottoms out in October of 2022. So you're talking about like a 2-year period. This is going to be the 3rd year of declining bond prices. It's unbelievable. So if you had a long-term view of, well, it can't go any lower, I'll just buy it now, and sit on it, you could do that. But the direction is obviously down. So yeah, keep bonds on your radar, but now is not the time. I mean, the way I look at it, here's the top. 1, 2, 3, 4, and we're in this 5-wave down. We get down here somewhere, and we're going to have a really good opportunity to get some big corrective move, meaning correcting this big down move to the upside in bonds. So at some point, bonds is going to be the place to be. And I don't want to get into all the reasons why right now. At some point, we're going to do a big macro show, and that's going to be it. But all right, am I missing anything? This is It's been an exhausting week.
Questions. If you have questions, as usual, put them in the comment section where we found the video.
You know what? I got one more thing.
Oh,
yeah. If you have questions about any of the analysis that we do, if you're a subscriber and you're reading the newsletter, the alert analysis, if you're watching the podcast, and you have questions about the analysis, please ask them. It is not helpful to throw rocks. I mean, do it if it makes you feel better. I don't care. But it would really help me.
It's not productive.
Right. If somebody said, "Hey," and we've had people say, could we use a different moving average? Would that get us in or out, closer to the top? Those questions are awesome.
Right. That means the person's trying to learn how to do this.
Right. And there's not necessarily black and white answers to those questions.
Right.
But those are the kinds of questions that are helpful to everybody.
Yeah.
Right. But if you want to throw rocks.
Yeah.
I pretty thick skin. I couldn't care less.
Oh yeah. At the end of the day, we don't give a lot of thought to that because we can't. Yeah. But it's just not productive. No. That's the point. If comments are productive comments are useful for everyone. We love it when someone asks a question because I think to myself immediately, if that person has that question, there's 100 other people that have it that didn't feel comfortable asking it, and we love that.
The first question, that we did at the beginning of the show was a great example.
Yeah, exactly. So if you have questions or rocks to throw, either one, you can do it in the comment section wherever you find it. If it's but as a reminder to subscribers, if it's about the newsletter, put it in the newsletter comments. If it's about the alert analysis, put it in the alert analysis post, because that gives us context. Because sometimes we'll get these crazy questions and they don't tell us what they're asking it about, and we're like, we have to kind of figure it out or go back and ask them. But put it where you find it. If it's about the show, put it in the show.
And we got the members only webinar coming up this week. And so I would really hope that there are a bunch of questions about the alert this week and the last couple of alerts. So that's definitely the time that we can interact. It's through the chat box, but we can interact as long and as specific as you guys want about that.
All right. We're done with the show. If you guys have any questions, get them to us. You can always send them to support@growmytsp.com. And the support team will get them over to us. Hope you guys have a great week. And we'll see you.